Okay. Should we always have, how about anytime?
So
Yeah.
that works. And actually, they probably haven't heard anything about kind then, even from the beginning. So
Yeah, that's fine. That's why we also, have this live. It's the thing about live is that you are getting it, like, full blown, like, raw information. It came on for a second. You should be hearing now because I'm getting it. There we go. Okay. There we go. We got it. Thank you for, being patient and stuff. And I'm sure everybody's really excited about, this topic of mortgage and home mortgage and lending and, refinancing sales. So we're going to go here and start again because things like this happens. Life happens. And we can just go wing it and go with it. So, and again, my name is Chime with Ask Chi Anything here every Wednesday at 6 p.m. on Pacific Standard Time here on Facebook and YouTube. And today we got a special guest, Linda Weldon from Kind Lending, going to talk to us about mortgage.
Hello.
So now that we are working, we're going to go ahead and start talking because also you have 6 people watching right now.
that's exciting.
So now that people can hear, they're going to really curious what's going on. So let's go ahead and start over and talk about, how'd you got to this here and, your business, the kind lending, everything. So,
Sure.
Yeah.
Well, what we talked about was we're right here live at my office, actually, here at Kind Lending and in Roseburg. And my office is 2198 Northeast Stevens. We're on the corner of Northeast Stevens and actually Exchange. So it's kind of fun. I get to watch the airplanes take off and arrive from periodically. So
That's pretty cool.
Yeah, it is. And I'm in Suite 201, so I'm right up the stairs. So you come on inside the building here and then take the stairway and you come straight into my office. So we'd be excited to see you here.
Awesome. Yeah. So, Linda, we were just talking earlier. You are a local, Roseburg born and raised. So tell us a little bit more about that.
Okay, thanks, Chime. Yes, I was born and raised right here in Roseburg. Went through high school here in Roseburg. Married my high school sweetheart, Dave Weldon. He's my sweetie, and we've been married now 47 years. So it's pretty fun. Also, recently our children moved back, so we have a daughter and a son, and our daughter and her family recently moved back. So I'm getting to see my grandchildren on a little more regular basis. I'm enjoying that.
Yeah.
And my son lives in Newburgh with his family, and
Have anything to do with the internet service?
probably,
Really?
yeah. Internet sometimes is a little interesting in the evening, it seems like.
Really? Okay. All right, we're back now. So let's continue on.
Yeah.
So Linda, tell us a little bit more about Kind Lending.
Sure.
What is this, this mortgage lending? Because it seems like there's so many mortgage companies out there. What makes Kind Lending special?
Yeah. Well, Kind Lending is just exactly that. Our CEO is Glenn Stearns, and Glenn Stearns actually started Stearns Lending 28 years ago, built it to a $24 billion company, and a few years back sold Stearns Lending, ended up with a huge investment company, and that investment company actually sold it to Guaranteed Rate. Well, Glenn loves the mortgage business, and at that time he was actually going through some medical issues that he has definitely come out of, and decided that not only did he start some other companies, but he decided to start Kind Lending with the idea that it was going to be just that. It was going to be kind lending. So easy and easier, common sense underwriting, just seasoned people that are involved. So we have seasoned loan officers, seasoned processors, seasoned closers, seasoned funders, and seasoned underwriters. And I love that because there's just so many more ways we can be kind about things because we know exactly what needs to be done and how to make it happen. With the common sense underwriter, it allows us to do some things that not all other companies are able to do. So
that's actually amazing. As a realtor who works with a lot of buyers, there's always moments where we worry about like, okay, is this gonna not just pass appraisal, but pass underwriting? Obviously, like a lot of time, like we're like, this shouldn't be an issue. Why should it be an issue? Mm-hmm. But depending on the lending company, mm-hmm. their underwriter could be a little nitpicky. Mm-hmm. So it sounds like you guys really have a business to really like common sense, work with the people, yes. really focus on the customer, on the clients, yes. on their needs.
Yeah, yes. And the communication, so we have great communication, and so it makes that's important because you want to be communicated, you don't want to be over communicated, but you do want to know what's going on through the process, and you will be a part of that throughout the whole thing. Always very kind. So it's been a lot of fun. I love being here. So we were kind of talking about the background a little bit. My own background, I actually created a mortgage, a lending department for a bank in Ronan, Montana, called Valley Bank of Ronan. And that was a number of years ago, and like in the 90s. And that mortgage entity is still thriving and doing super well. So I guess I did some good there. And then came out here, and I've been in lending really ever since that point in time. Had my own office here for 16 years. That was Mellon Mortgage, and then became Chase. And then Chase bought Washington Mutual Bank, and so they opened up a Chase office in Fred Meyer. And soon after that, Wells Fargo had been trying to get me to come aboard with them for several years. So I decided to try Wells Fargo out for about 11 years. The same gentleman that brought me over to Wells Fargo later went aboard Stearns and Kind Lending. And so 11 years later, I finally said, okay, I'm ready to start my own office again. And so I ended up choosing Kind Lending because that's who they are. They are kind. It's been just a blast.
Well, that's an amazing journey that you really, like have this amazing career that's in, mortgages. So, mm-hmm. Anybody who's, put their hands, put their mortgages in your hands, you're going to be taken care of because you have these experiences, and you definitely like, one of the reasons why I refer clients to you is because you really want to take care of my clients. You want to make sure I also in full communication. Yes. I personally have experience with lender where like maybe I'll talk to them once or twice. Or if you look working with like, some online mortgage company like Quicken Loans or whatever, Rocket Loans, trust me, my personal experience is before the escrow is closed, I will talk to at least 5 people who don't even know what the first other person had told me prior conversation. So it's nice to have a local lender who really take care of you, focus on you. So
yeah, that is definitely what I love to do. And I obviously I've been doing it for a long time. So I really like to help all of you out there build our communities together. It's so important to partner with realtors like Chime's so that we can concentrate on helping people that are maybe renting for a while, but then are ready to go ahead and move forward and get into their own home. Or even better than that is get into investments and become a land baron. So,
you're talking about, people who's renting and who's looking to buy the first home. Mm-hmm. So why don't we start looking at talk about the nitty gritties of, mortgages.
Okay.
Tell us kind of what is the process of mortgage, getting the first mortgage like, if somebody is like, I'm looking to buy a house, I have no idea what should I do. Yes, a lot of times they come to me first.
Yes.
So, and then I send them to you.
Mm-hmm.
So tell us what's the process when they get sent to you.
Yeah. Well, what's great about that is Chime knows that in order to become a buyer, if you're looking to need to have additional money besides what you have in your savings account, then you most likely are going to probably need a mortgage. And that's where I come in. And so However, there's a process to being approved for that mortgage. And so the first thing, you call me, we either set up an appointment or I send you a link and you can put in your financial statement right online, super easy. I love our link for that. It is not complicated and it's quick. And if you have any questions, I'm just a phone call away, or you can walk right into my door. So I'm here to make that easy. So as you do that, that's called being pre-qualified. And then Chime then knows that you've talked to your lender. Your lender says, hey, here's a letter for you to match up with the offer that you have found a property that Chime helped you select. And in that process, then that letter matches with your offer to the potential seller, and that seller is pretty excited because they already know that you've seen a lender and you're a buyer. You are ready to.
When you have that pre-approval letter, these sellers and the listing agent know you're serious. If you're shopping right now and don't have a pre-approval letter from a lender like Linda, most likely they're not going to take you seriously. Even a realtor might not even take you seriously.
Correct.
So it's important, if you're looking to buy right now, to talk to a lender right away. And obviously I highly recommend Linda. And I also recommend Linda no matter you live in Roseburg or not. So just so you know that you do not have to be local to work with her.
This is true. So adding to that, I'll just mention that I myself am licensed in not only Oregon, but also in California, in Washington, and Arizona. And then I have referral partners throughout the United States as well through Kind Lending. But I myself do that and have been very successful in those areas too. It's a lot of fun. It's a lot of fun.
All right. Well, so Linda, tell, obviously they talk to you.
Mm-hmm.
What are some basic documents that, a potential buyer needs to provide you to start this pre-approval process? Because obviously they're going to be sending you those or putting online, but what is it that people need to think about when they about to have that appointment with you?
Sure. So if we talk on the phone or if you go online it's nice because it actually prompts you those questions. So what we're looking at is your financial statement, which includes your income, your employment stability. We're looking at an average of 2 years of that employment. So depending on what type, whether you're self-employed or whether you're W-2, whether you might even be part of a union where you work different companies. So all of those things require different types of documentation. W-2s, pay stubs, tax returns, those are a lot of the normal types of income documentation that we'll be looking for, and usually covering a 2-year period. And if there are employment gaps, we can work with that as well, because we talk about those employment gaps, and as long as you're re-entering the workforce, it usually is not a problem. So that's kind of fun to kind of play with some of those variables that come across our way. The other thing would be bank statements. So we're looking at, do you have funds for a down payment? Are you getting a gift from someone? Are you going to borrow money to actually have for your down payment? And the other thing that we look at bank statements is your income coming through your bank statements? Are we still in the process of maybe saving some additional funds? Are you getting a grant? Are you able to do that type of thing? So we talk about those options as well. And then there's zero down programs, so that helps. Does that mean you don't have any costs at all? Well, no, it means that you still have closing costs. And those closing costs usually run 2 to 3% of your sales price, to give you an idea of how to kind of come up with a short calculation of that. And then, so we've talked about employment. We've talked about maybe the assets, proving where they come from. Some people actually use their retirement funds that they're starting to build. So like if they have a 401k or they've started one and they've had one for a while, they might be able to have access to their 401k funds in the form of even just a loan borrowing against the 401k, which is kind of a fun way to do that, because in reality you're borrowing from yourself and then you get yourself into a repayment plan. And then of course we're going to pull credit and look to see where you stand in the credit. One of the things at Kind Lending that we really have been building my reputation with is I have these programs where I can help you rebuild your credit. So maybe your credit's great, which is perfect, and we just kind of go on from there. But maybe you've got, if we can get your credit maybe to a little higher credit score, because as you might imagine, in lending, credit scores do have are we still on?
No, we are.
Okay.
Yeah.
Credit scores provide an analysis as to your repayment ability, basically. If your credit scores are a little lower, then we kind of take a look at that, and I can run some what if scenarios. And so, for instance, I had a client that had a credit score at 0 credit score. I rebuilt them up to a 740 credit score within 31 days.
How is it possible that someone has 0 credit score?
Well, if they've not ever applied for credit, they would have a 0 credit score. And so if you haven't applied for credit, but maybe you have, maybe you've been paying rent. Your rent doesn't show up usually in a credit report because they don't report to the 3 national credit bureaus like Equifax, TransUnion, and Experian. So if they don't, then you may be making that rent payment. But so what we do is we get a verification of rent from your landlord, and then, or we get your canceled checks to show that you have been paying rent, and that rebuilds your credit score, and also becomes what we call non-traditional credit. And some programs allow that, some programs do not allow that.
So essentially, there's a lot of these, budget gurus, like, don't have credit cards, don't buy, don't get a car loan and stuff. But it really, when it's good to be really financially responsible, but when you really have no credit usage, it might not be conducive to you trying to get a mortgage to buy a house, because not everybody have 200 grand saved up with this amazing budget, plan that these gurus does.
Right. Yeah. So that's what the credit report is it is a way to provide a historical view of how you've paid your credit on time. And mortgages, face it, they are like 30 years or 15 years or 10 years or, so they want to be able to see that you are able to make your payments on time over that period of time. That's why it becomes so important, I guess, to have that credit history. It's the way we analyze it. But there are those alternate ways that we can show that. But so when I'm looking at helping someone rebuild their credit, and again, I talked about the 0 credit score. So I have a program that allows me to say, well, what if? Well, one of the what ifs would be this. So the credit bureaus look that if you're on an authorized signer's account, so let's say you have a great aunt, or you have a mother or father or a family friend that would be that they have let's say they have a Bank of America credit card, and they've had that Bank of America credit card for over 2 years, and they've never had a late payment on that credit card, and they're willing to allow you to be an authorized user on that account. Well, once you're added as an authorized user, now that credit actually becomes part of your credit report. And that shows that you have a history of 2 years or 5 years, depending on how long that credit report's been opened. And so that actually shows that you have good credit. Isn't that amazing?
That is amazing. So how long does it take for them to add you to the account and then it shows up on your credit?
I'm glad you asked that question, because that's a very important piece of so this is a little detail, so bear with me while I explain this to you. So the person that has the credit card, okay, they would contact their financial institution, Bank of America, and say they would like to add you as the authorized signer. So that's fine, and then they add you as an authorized signer. Well, financial institutions generally only report to the national credit bureaus once a month. So depending on when they report that information, it's not going to show up with the bureaus until it does get reported. So the owner of that account, that Bank of America account, can ask Bank of America, what time of the month do they generally report that information? Because just because they've added you, it still has not been reported to those bureaus yet. So the other way they can tell is, here's a little a trick of the trade. So there are different companies out there that will provide you with your credit scores from month to month to month to month. One of those entities, it might be Credit Karma. Credit Karma actually it has Experian and trying to remember, Experian and TransUnion, I think, are the two companies that report through Credit Karma. So if the person that has the Bank of America account also has, is watching their credit, and so they've signed up with Credit Karma, and so they get their credit report. They can actually look at the credit report the previous month and see when was the last time, what was the date that Bank of America had reported that credit history. Isn't that interesting?
That's interesting.
And so let's just say they say, well, okay, well, it was last reported on May 25th. All right. Well, we're June 15th now. We would want to wait until June 25th before rescoring your credit score so that it shows that you are now an authorized user on that account. So we would wait an additional 10 days, maybe 15 days before we rescore your credit report, and it will then be impacted, and you will now have a wonderful credit score of maybe 740, just based even on that one credit being reported on. So this is the other piece to that. Make sure if you're going to become that authorized user that the person that you're getting on that account actually has that good credit. So if they had a late payment in the last 12 months, that's also going to be reflected on your new credit report. And you do not want to be part of that. You want to have someone that's had at least a 2-year history and no late payments.
That's a really good good advice.
Yeah.
Wow, even I don't even know about this whole process. So that's pretty darn good.
It's kind of in depth, but
So, all right. Well, why don't we talk about the different loan programs on there? Because you mentioned the zero down programs. You mentioned grants, but most people only know what's the FHA or VA and stuff. So can you kind of give us a little rundown the different loan programs, the common ones, as well as I guess maybe some special ones that you might have to offer?
Yes, absolutely. So we'll just start with some of the basic programs. So USDA is designed for first-time home buyers, but you do not have to be a first-time home buyer. It is a zero-down loan product. It does have income eligibility restrictions. I believe that amount is for the year is $96,100. So as long as your income, household income, not just your income that's applying, but anyone in your household, all gets combined together to come up for the eligibility requirement of that particular program. Family of 4.
Okay.
And if you have 5 or more in your family, then that eligibility actually goes quite a bit further. So I believe it's like 110,000.
Oh, wow.
Plus.
Yeah. And then in Roseburg, USDA is for rural areas like Roseburg and Douglas County.
Yes,
you can't use that in Eugene, but it's really more for rural areas.
Yes,
I guess.
Our entire area, Douglas County, is all eligible for that USDA zero down program.
Okay.
So, and it's a wonderful program. Also, different lenders have some overlays on those programs. So where one lender may not lend if your credit score comes in below 640, Kind Lending, as we said, we are common sense underwriting. We take a look really at your credit, and anything above 600, generally I can take a look at that USDA program for you.
Oh, wow.
So it's pretty cool what we can do here at Kind Lending. I love it.
Okay.
One of the other zero down programs would be like VA. So if you're a veteran and you have a VA eligibility for their home programs, Kind Lending loves to help our veterans. We thank you actually for your service to our country and your sacrifice that you have made, and welcome home. We're glad you're here. So with that, it is a zero down program. The VA also has what's called a funding fee that they charge, but they allow you to finance in the loan. So it's a zero down program. And on top of that, if you happen to be one of our disabled veterans, then that VA funding fee is actually waived for you as well. So I'm really grateful to our country for providing this VA program for our veterans, because they deserve it, and we want to be able to help you do that. Get into those homes, get into another home. Keep in mind, even on your VA eligibility, you may have a home in North Carolina that has your VA eligibility that you used. Well, and now you've moved to Oregon, but you haven't sold your North Carolina home yet. VA eligibility has remaining eligibility that you may very well be able to buy another $300,000 home right here in the Roseburg area, even though you've already used part of your eligibility. So keep that in mind when you're talking to your lenders, that just because you have that property over there and it's used part of your eligibility, you may have some remainder left.
That's pretty awesome. So you can almost kind of buy a second home with it?
Yes.
Oh, wow. Okay.
Yeah.
So what is the total eligibility right now?
Well, actually, we do lending up above $1 million on the VA loan products.
Oh, wow.
Okay. So it depends on, there's a calculation that's involved. And so you just talk to me, Linda Weldon, at Kind Lending, and we'll get that calculation and get you pre-qualified for a VA loan right here in the Douglas County area, or in the other areas that I'm licensed to lend in.
Awesome.
So,
all right. So what are the programs you have?
So on top of that, FHA. So FHA is your next great program to help people that might have credit challenges, and also the down payment. It's designed for first-time home buyers, but again, you do not have to be a first-time home buyer to do FHA. FHA allows for a 3.5% down payment. And that makes it a little bit easier for people to get into their home loans. Also, FHA allows for stretching of what we call your debt to income ratios, which all loan programs have debt to income ratios. And what they do is they look at your housing expense to your income, and then they look at your total debt expense to your income. And when we talk about total debt, we're really talking about anything that's reported to the credit bureaus. And we use that monthly payment and your monthly house payment to come up with that qualification process. Your target is, you always want to be like that. The golden rule is to try to be 33% of your income, of your gross income. However, all those first-time homebuyer programs understand that maybe there's some extenuating circumstances. So I've taken people all the way up to 50% of their income to be able to get them into a home and their monthly debt. But we help you. I like to help people understand their cash flow and how their monthly budget is. So just because you're eligible for that amount of a loan, because of that, you may not want to do that, and you want to look at your budget and how it affects your own home so you're not house mortgage payment poor, and you can continue to enjoy the daily benefits of living our lives out here in our area.
Yeah.
Yep.
All right. So, what other programs you have left?
Okay.
Also, I remember hearing you mention investors too.
Mm-hmm.
So go ahead and tell us what other, conventional.
All right.
And anything else.
Yeah. So we've got the conventional programs that are 3% down, and 5% down, and 20% down. When I'm looking at a veteran, for instance, and I talked about that 0% down, but they have 20% down. Well, a lot of times the VA product interest rate program may be still the best program for that veteran, even though they could also qualify for the conventional product as well. So we take a look to see your financial picture and what your options are to try to give you as many options as possible so that you're fully equipped to be able to make the best choices for you and your family.
Perfect.
So on top of the conventional program, then we have investment programs. So generally speaking, to buy an investment property, you're looking at putting 20% down or more on a program. Well, sometimes you're an investor that has several properties or one other property, or you're just a first-time investor. Well, I have a program that makes it super easy for you. So as long as you own your current home, all right, then we don't ask for employment information. We don't ask for those tax returns. We don't ask for those W-2s. We don't ask for those pay stubs. So as long as your new mortgage payment on this investment property, this rental property that you wanted to buy, as long as the rental income or proposed rental income equals the new mortgage payment on the rental, we do the loan. You can have as low as a 600 credit score to be able to do that program. Keeping in mind that, again, is if your credit scores are higher, your interest rates get a little better. There's always a benefit to that.
That's pretty cool.
It is. It's a fun program.
Yeah.
I've done them, and it's a fun program because it goes fast. We just get an appraisal and we close. So it's a 2 to 3 week process.
Yeah. Well, so here's something that, at least locally, been an obstacle for some of the homes to close soon. It's appraisal.
Yes.
Can you kind of tell, our audience a little bit more about what is this appraisal? What's the process? Why we even need to have it?
Sure. Well, an appraisal, so she gets to go out to the property. She sees the properties. She brings forth many properties for you to view, to choose from. She'll make appointments for you so you can go out to the property, or you can look at the virtual property virtually in the electronics. So that's all great, right? Mm-hmm. The lender, though, we're doing a mortgage and a loan on that particular piece of property, but the only way we can know what that property is and that it meets the program or loan program guidelines is to have a professional go out, view the property, take the pictures, do a market analysis. They'll sometimes look at 6 or 9 other properties and give us all the details of those 6 or 9 other properties. And that takes some time to do that, plus a good background of their own properties that they would have. And they will even reach out to Chime and ask for her to provide them with some comparable properties to that particular property that you're interested in purchasing, and that we're helping you with the loan product to buy it. So the appraisal is very important to the lender because that's the only way we know what the property is. It's the only way we know what the acreage of the property is, if it's 0.33 acres or if it's 50 acres or 150 acres, is the property, what do the pictures of the property look like? What is the appraiser's opinion about how its market value is if it was to turn around and be sold again? So it's a very important piece, is that appraisal. And so we ordered that immediately, because the reason we do that is because it also takes time to get that appraisal back. For us to order the appraiser, it goes usually to a third-party service because the government entities believe that they don't want me talking directly to the appraiser. So they have us go through third-party vendors, and those panels then also have approved licensed appraisers on those panels. And within that, then basically they send out an invite to all these appraisers on these panels and ask them, will they accept the order? And if they accept the order, how long is going to be the turnaround? So they look for the quickest appraiser that responds to that information.
Okay, that's cool. Yeah, here in Douglas County, we don't have a lot of appraisers, and we were still in a market that has a lot of activities. So it could take about 3-4 weeks before appraiser goes out to a house. I'm not saying that's all the time. Sometimes you could actually order a rush that is significantly more expensive. But so what is it right now as far as typically closing time, your timeline right now from the day they accepted offer to when we're looking at closing?
You're still looking at 35 days to 45 days,
Okay.
Probably closing time.
So that's pretty
from
good,
start to finish.
so.
So that's, it's actually pretty good. The appraisers, it kind of depends on where the property is located. So if you're right here in the Roseburg area or right inside city limits, generally the appraisers will accept that order a little faster than they would accept something where they have to go outside the county limits or outside the urban growth areas. So you can expect a slower turn time because they actually have to get more comps because there's less comparable properties to choose from. So they call that working a little bit harder. And and sometimes that means an increase in the appraisal and the cost. Just so you know, we Oregon people, our appraisals actually are one of the most expensive appraisals in the United States.
Oh, wow.
This is what I kind of think about that question, is that to become an appraiser in the state of Oregon, the appraisers must go through college for 2 years at least. They then must work under an appraiser. So they've got to find an appraiser that's willing to have them come and work under them for 2 years before they can ever become licensed.
Oh, geez.
So we have one of the most strict ways of becoming an appraiser throughout the United States. So I think that may be why that contributes to some of why the fee is so high in Oregon. But we can go to California or any of the other states, and I mean, they can be half the cost.
Oh, wow. I did not know this.
Yeah.
So thanks for the information.
Yes.
Yeah. Don't go back to California, though. Stay in Oregon.
Yes,
so,
absolutely.
we can figure this out.
We want you here. That's right.
All right. So one of the biggest topic, we got about 15 minutes left, is what's going on with the market. Give us the state of market.
Sure.
Because, I know that you can't really give us any specific interest rate because just like you mentioned, it all really depends on individual income, credit, job history and such. But still, give us some lowdown on what is going on with this weird, interesting market that has been going on the last 2 years. Now, where the kind of the interest rate picking up, like what is this all about and how does that affect the mortgage industry?
Sure. So I'm going to do just a little bit of reading, get a little banky with you a little bit. So bear with me on that, okay? But if you hadn't noticed, the markets have been a little crazy even this week. Yes. The Feds actually today made an increase to the Fed's funds rate. So the Fed's funds rate affects consumer products that are tied to interest rates. So such as credit cards, mortgages, and adjustable rate products. So what also that means is, for instance, your home equity lines of credit would have probably a bump because the Fed funds rate has changed. Fed funds are also the funds that the banks lend to themselves. They use that Fed funds rate for that interest rate. So when they said today, they announced a 0.75 or a 75 basis point rate increase equals, so when you hear the word basis point, that's a one hundredth of a point. So 0.75 is 75 basis points, and that's what the rates went up today. So you'll see a change on your home equity lines of credit where the rate, it might be an adjustable rate. Indirectly, you will see it affecting the actual fixed rates, the other mortgage rates, the 30-year, the 15-year, the 10-year, the 20-year. Those fixed rates will be indirectly impacted. But what it did cause is the stock market actually did some rebounding. So that was kind of nice for those of us that also have stocks or are involved with 401ks or those types of investments too. So one of the things that's impacting these mortgage rates is inflation, and that's where the federal government is trying to make sure that the inflation just doesn't go and that we don't actually ultimately end up in a recession. So they don't believe that we're going into any kind of recession. So I want to make that very, very clear. They're being very direct on increasing those rates because they believe that the Fed funds has a relationship in there, and they want to slow things down. So they want to slow purchases down. They want to slow refinances down. They want to slow the market down a bit so that all the other things that are impacted by that, the cost of wood and lumber, all of those things that go into that are just slow it down so that inflation doesn't continue to rise. We are actually at an all-time high in the last 20 years of the inflation index. So I'm going to look at my notes here for just a moment. The consumer price index showed inflation kind of red hot as they were talking about it in May, running at an 8.6% pace.
Wow.
And that is the highest year over year since 1981.
Wow.
So where their goal is 2%. So they want a 2% inflation index. And so you can see the reason why they're wanting to try to slow things down a bit.
Yeah. Sylvia Simpson, say hi.
Well, hello, Sylvia Simpson. Nice to hear from you.
Yeah. So, all right.
Hope you're having a great evening and that you're gaining some information here tonight.
Yes. All right. So, sorry to interrupt.
Yes.
Okay.
Exactly. I'm just, so as far as interest rates go, you're going to see them continuing to increase. And the Fed funds is talking about raising it even more, maybe even possibly another 0.75 by the end of the year. So,
so as far as consumer goes, our buyers and also homeowners, what is the implication for them as far as with all these, Fed rates increase and also the inflation? What is the implication for them? And I see you got a nice little chart here.
I do. I have a little bit of a mortgage rates chart. And it shows you, sorry, I have to look at it for just a moment, which side to start at. So this is where we are now.
Mm-hmm.
And this is historically back to the year 2000.
Oh, wow.
So you can see we're still not even as high as the market has been over the years as far as interest rates, mortgage interest rates are going.
So back in 2000, interest rate was over 8%.
Yes.
I was a kid at that time, so I didn't know better. So, but yeah, that's pretty gnarly. So we are still pretty low. Yeah.
Camera, sorry. There we go. Sorry, I'm moving that around and finding the camera picture there.
And I'm sure if you go to Linda's website and even come to her office here, she will give you a lot more education.
Oh, absolutely.
Yeah.
Absolutely.
So, we also do in your chart, it does look like, really in the last 6 months, there's been like a spike,
it has been.
In interest rate.
But they're still lower.
Still lower.
They're still lower than they have been overall. So it's still a great time to take advantage of the interest rates. And as you were talking about, you mentioned the market a little bit in the real estate market. Share with us a little bit about that.
Yeah. So, as of as of May, we're at least here in Douglas County, we are still 2 months inventory. What does that mean is if nothing came on the market as of June, we would still be sold out in less than 2 months. It's 1.8.
That's
so
crazy.
So with that being said, even though the interest rate has increased, we are still only seeing about a little bit over 200 homes coming on the market, and with a relatively about the same amount of rate of homes being sold. So if you're looking to buy, this is still a good time because we are still looking at about 15 to 20% price increase. I do understand that, because I also work for a buyer, having such an increase in sales prices still, and with the, we're about 2-3% increase in interest rates since beginning of the year.
Yeah.
Depending
on the program.
Depending on the program.
Right.
How is kind lending working to mitigate that with clients? Because I know for myself and other, agents that some of our clients just got kind of, their budget just either shrunk or now they got priced out. So how is kind of lending able to try to help them a little bit?
Yeah. Well, and that's where having a variety of programs really comes into play, to be able to maybe take a look at because each of these programs basically have their own interest rate that go with them.
Okay.
They have their own those debt ratios that I talked about earlier. So your debt to income, for instance, FHA, you may qualify for a $300,000 home on FHA. USDA maybe only $250,000.
Oh,
Okay. So that's where we kind of take a look and see, all right, how is your buying power? How has it been affected? And what are you able to do now? And maybe we were looking at this program at one point, but if we switch you to this program, your buying power just increased quite a bit. So it's
really being able to be
fun,
flexible.
actually.
Yeah, being able to have flexibility and a lot of different options.
Mm-hmm.
So you don't feel like, clients just don't become hopeless. Like
Right.
you actually work with them to, figure out what's next.
Yes,
So,
yes.
all right.
And it's amazing too, because if your credit is such that, maybe you've got a couple of vehicles or something where you could even possibly refinance the vehicle and lower the payment by, like, let's say $100. Let's say you have a $500 truck payment right now, and you can maybe get a refinance on it because you've had it for a while, and maybe get still a decent rate and refinance it and lower that payment even by $100. That buying power is going to get you almost as much, well, probably about $40,000 in a home mortgage.
$40,000
just by lowering that payment by $100.
Wow. Yes.
So there's a lot of different ways that we can approach things to still get you into that dream home or that investment property that you've been hoping to do.
That's pretty good, and I know that some people, it's like, I just can't do this, can't do that, but it sounds like you talk to Linda and she's going to help you figure this out. She's going to look at your budget for you and look at what your current asset is, your debt is, and really figure that stuff out. So, all right, we got about 7 minutes. You got any information that our audience might be interested in as far as mortgage concerned? Maybe, like, do you have any things that, like, maybe for homeowners, looking at refinancing? Are there where you at with that?
So one of the things that I was just kind of looking at in my notes here is I wanted to chat with you about some things that have happened with the credit bureaus just recently.
Okay.
So, and how credit is being reported to the credit bureaus. So again, that's TransUnion, Equifax, and Experian. Those are the three national reporting bureaus. So one of the newest rules that the CFPB, that's our government, has come out, they have agreed that medical collections that are paid medical collections are to be removed from the credit bureaus. So the credit bureaus are no longer to take them into consideration in that credit scoring process that I talked to you about earlier. And that can affect quite a few of you, and helping your credit scores actually to improve and to look better. So again, that's medical collections. All paid medical collections will be removed from a person's credit report.
Wow, that's pretty good.
It is. Now, keep in mind that is a process, and they have mentioned that it will take some time for the credit bureaus to go through all of you to have those removed. But there are ways that if you do have those medical collections that are paid, there are ways that here at Kind Lending that I can help you, direct you to get them removed yourself as well. So
awesome.
There are ways to get around that.
That's pretty awesome. New information.
Yeah. That was one of the big changes, because that's a big change.
Yeah, especially for a lot of elderly, like those medical collection, or for disabled folks, like, it's not like you want to have these big medical debts. It's just, it just happens. And to have that really stop you from buying home, especially if you actually pay them off, like, it makes no sense that that will be going against you. So,
and then as we were talking about that, we didn't talk a whole lot about the conventional loan products, and we didn't talk as much about what mortgage insurance is. So to to clarify, there is private mortgage insurance or mortgage insurance premium, and then there's homeowners insurance, or we call it HOI, right? So, or hazard insurance. But homeowners insurance is actually protection like fire insurance, earthquake insurance, that protects your home from those types of damages. Mortgage insurance actually protects the lender. So against the potential risks of default, whenever a lender is lending more than an 80% to the value of the property, and you're in that 85% or that 90 or 95% or 97% or even the 100% area. So mortgage insurance premium companies have come out and said, hey, lender, if you will go ahead and use your funds and go ahead and lend to these people with the lower down payments, then we will do a type of guarantee or an insurance to cover some of that difference should that particular borrower go into default on their loan. So it doesn't cover the whole mortgage, but it does cover a percentage of it, and it is an incentive for the lenders then to go ahead and lend more than 80% of the value of the property. That mortgage insurance premium is different with each of the loan programs. So for instance, VA programs do not have mortgage insurance, so they don't have to pay that mortgage insurance premium. That mortgage insurance premium, by the way, is generally added in your mortgage payment, your monthly mortgage payment. So on a conventional loan, that mortgage insurance premium varies depending on if you're putting 3% down, 5% down, 10% down, 15% down, and goes away entirely at 80% or 20% down. So what happens also is because of that sliding scale or those tier levels, if you're able to put that 10% down, that monthly mortgage insurance premium that if you were putting 3% down might be $350 per month added to your loan amount. Versus if you are able to put that 10% down, then that drops it down to maybe $50 per month.
Wow.
Or $85 per month. So it can be a big impact if you're able to somehow come up with that additional money. And we'll give you those options when we're talking and we're looking at your financial statement.
That's pretty cool. And also I know that with different types of loan, you might not have, you might be able to, down the line, actually remove the mortgage insurance.
That's correct.
So, but some can't. So, which loan type typically allows you to remove them after you hit that 80% of equity?
So, the conventional loan products, which is Fannie Mae, Freddie Mac, you may hear them. And what those are, they're the secondary market, and they're what provide the product guidelines of which we can lend in, and so that the secondary market wants to invest in our mortgages, and so that product is one where if you get to 80%, and then at 80% you can request it be removed, and then at 78% it's automatically required to be removed.
Oh wow, okay.
Mm-hmm. And then FHA on the 30-year mortgages, if you're putting the 3.5% down, that is for the life of the mortgage or until you refinance into a different type of a product.
Okay.
If it's a 15-year loan, it lasts 11 years. Okay. So it doesn't last the full 15 years.
Okay. All right.
So we kind of take a look at that.
All right. Well, we are actually at 7:00. You actually wrapped it up just perfectly. So, and as always, if you have any question about mortgages or real estate, buying a home, selling a home, feel free to ask me, or also go to Linda with your question. And until next week, we're going to talk to you again at 6 p.m. on Wednesday night at Ask G Anything. All right, guys. Bye.
Bye.